This week, we have 4 very interesting webinars lined up, and we hope you can make it to the one that interests you the most. The first one at 10 a.m. is Debt versus Arbitrage, in which we will talk in detail about the two asset classes. At 11 a.m., we have Strategies to Save More, in which we will speak about various ways to effectively increase your savings and secure your financial future. At 12, we have a webinar on India's capital cycle, which will talk in detail about the current capital cycle of India and the valuation of the markets. We have another very interesting webinar at 12, Setting a PMS Milestone, which will explore the strategic decisions that one needs to take to shape a successful PMS. We hope to see you all there.
Good evening, friends. It was such a nice talk that Shyam gave, a lot of macro data. When I was asked to speak, I was wondering what to speak. First, I thought of talking of Munger, Lynch, and all that stuff. Then I thought I don't want to put people to sleep on a Friday evening by giving yarn. Then the thought occurred to me that it's a Diwali talk. Let's talk about something related to Diwali. And suddenly it appeared to me that it's not a bad idea to talk about slaying the demons. For an investor, the demon is always inside him, it's not outside. If you are on Twitter, you will think that the demons are outside. But in reality, the demons are all inside us. And it's so important to slay the demons inside you if you want to grow. Because at every phase of your evolution, you have to be a newer or a better version of yourself. And that's what makes interesting the journey of investing for every one of us. There are times when you ask yourself, what is a 93-year-old man doing investing? What is he investing for? And then you see that a 99-year-old man is buying a new stock months before he dies. What is he doing it for? And you understand that investing is basically a way of life and a discipline for most people. And that evolution which you do all the time is what makes it interesting. But it's very difficult to evolve from one version of yourself into another. If you see, at the end of a market cycle, what are we doing? We are resisting change. We are resisting opinions which are not agreeing with us. We are resisting people whom we think are from a different school of thought. We are resisting business ideas which we believe are archaic. So, if you realize at a point like this in a market cycle, we are full of demons inside our head. And unless you slay these demons, you're not going forward. And the stubborn refusal to slay these demons in our head basically wastes a lot of time into the next cycle. So typically people spend a lot of time into the next market cycle hoping that the glory days will come back, when they actually should have been using the glory days to start preparing to become a better version of themselves. And interestingly, nobody else can help us in this journey. It's entirely up to us, it's totally in our hands, and it is our duty to slay our demons. And that's what I thought I will speak today. I hope I don't bore you. Most of the questions that I am going to raise here in this speech or talk are questions that I am raising to myself. If some of you like these questions, you can raise it to yourself. It will be very interesting to raise some questions and ask ourselves some things which we generally hesitate to ask ourselves and try to find some honest answers. The first question, are you a trader or an investor? Most people don't know this. Today, in the fund management industry, and especially in mutual funds, most fund managers are traders. They are not investors. I'll tell you the reason. Because they have a benchmark to beat every month. And unless they trade, they cannot beat that benchmark. And look at the system of taxation. It turns investors, very competent fund managers, into traders because they don't want to fail in their job. A lot of people whom you see talk about teams, sectors, the latest, the future, India's glory days, to justify specific investment decisions and to convince you. Anyone who is trying to convince you very aggressively about something would actually be a trader, because after convincing you, he is going to sell the very same stocks to you. But from your perspective, you may think that he is an investor. If I talk about 5 stocks today, chances are that I may have to sell that stock a few months down the road because quite a few people may buy those stocks and it may run up. So even if a person is well-intentioned and is talking from a perspective of an investor when he is talking, he is going to turn into a trader. And then there are 2 schools of thought, very separate is what we think between investor and trader. Firstly, I think traders don't buy great investments. Mostly not. That is why they are forced to sell. If you buy a stock like Geico and own it for 4 decades, that is investing. But if you buy something which you have to sell within 6 months, like an aviation stock, that is trading. The same person may do 2 things, but you may mistake both to be investing. And investors who go towards trading always trade their winners. There are many people who have bought Nvidia, and I think one of the most prominent fund managers said that he sold it after making 3 or 4x. This is a very, very common thing that happens in our life because we feel compelled to become a trader. And investors are also criticized very heavily for holding on to losing bets. You don't want to accept that you made a mistake. So, because you don't want to accept, you wait hoping that your mistake becomes a success. And that time has the solutions. Never works. I would think that a person should be very clear whether he is an investor or a trader at points like this. Because today, if you're going to deploy money into new ideas, you're better off being a trader than being an investor. But you might have told yourself that it's in your DNA to be only an investor. But you want to deploy money. That conflict will never end well. You will probably be a bad trader who turned into an investor because your bad trade is something you don't want to sell. So that is something that at this point is very, very important for you to understand and completely avoid. If you made bad decisions today for purchase and you can't sell it, you become a backdoor investor. And that is something that you should avoid at this point in time. Another question that is very important is, what is your investing age, not your real age? How many of you are 5 years young, 10 years young, 20 years, 30 years, or like me and Narayan outside this slide? Many of us are outside this slide. We are outside 30 years in terms of our investing age. How many years have you been an investor? Anyone who is outside of 30 in this? Oh, there are a few. Good. How many of you are under 5 in this? Under 5 years. There are a few in that set also. Why am I raising this issue of investing age? As you age, you're supposed to demonstrate maturity. Your maturity should grow. There should be some wisdom that investment age helps you to gain. But I've also seen people who have been 3-4 decades in the market. wanting to participate in everything that a very young person is exploring, wanting to try out everything. There is so much of FOMO. The fear of missing out is so high, and it seems to be increasing with people who have a higher investing age, which is ridiculous but true. I would think that one has to condition oneself to act his investing age. Are you investing to your age? Is it reflecting in your investing? I saw in the Zomato issue that people whom I really respect actually had applied in it. And I asked them whether they're convinced in the company. He said no. But they want the listing pop. So most of the people in the market, especially at a point like this, are not acting their investing age. They are acting much younger than their investing age. And you have to ask yourself a fundamental question whether it's actually going to help you or hurt you. In my opinion, I would think the prospects of not acting your age being harmful to you is higher than they being helpful. The third thing is, do you have a deadline to make returns? Have you set a portfolio target for March 25? How many of you in this room have a portfolio? My portfolio in March 25 should be X. Do you have a number? At least a few have a number. Others have a number, but they're refusing to acknowledge it. Everybody thinks that portfolios should go linearly to meet deadlines which they have set for themselves. But while there are instances of portfolios doing more than what you expect out of them, when you least expect them to do it for you, there's never a such situation where portfolios have actually met any deadline. So if you actually have a deadline for your portfolio today, rest assured that you will fail to meet it. I'm quite certain that you will not meet it for the next year or so, at least until the next Diwali. Most people have spent many years in their investment career, and I ask them the question, which is the best idea in your investment career? And then they'll think, you're not clear. You've been in the market for such a long time, you've traversed some hundreds of stocks, but you can't come up with which is the best idea of your investment career. You weekly come out with some name, say, okay, yeah, this is the best idea of my career of investing. And then the next question, do you really know why it was the best? Can you tell me in a short hypothesis why you think it was the best and better than the number 2 and the number 3 idea? Most people have no idea. Most investors live in the present. They never look back at their journey. They never see what went right, how they got something very right, what made them succeed at something. Because once you succeed, in your mind, you think you deserve that success. You think that it was your destiny to succeed and only yours. In that, you lose the opportunity to understand your success, to logicize, to know why something that gave you so much actually happened to you, and to conclude why it was the best idea in your investment career. When you do this and miss this opportunity, you also forget to record, or what do you say as diarize, put it in a diary as to what worked for you, which you can take later into your future. People actually forget to record their best success, and it is true of most of the people. Now we'll come to the current portfolio. How many of you can tell me what is the best bet in your current portfolio? Which is the best stock in your current portfolio? How many of you know clearly that this is the best as of today in your current portfolio? Most people build their portfolios like it's their morning walk, something they do habitually, or their afternoon lunch, The amount of thinking that goes into a portfolio in bull markets is astonishingly less than what is desirable. People have a lot of stocks. When you see their portfolio and ask which is the best, they will point one. Then you get into an argument or a discussion or a debate, depending upon how they receive your feedback as to which is the best one. Why is this not better than that? Why are you saying that stock B in your portfolio is not better than the stock that you are calling the best? And they'll keep changing their mind. It's very, very normal for people to be so unsure. Reasoning out why. If you have a portfolio, do you have a journal of each stock and why you bought that stock and why it is the best stock in your portfolio? At least for the best stock, do you have one? That's my question. Most people struggle to reason out. And at a time like this, when you're making more and more decisions and changing your portfolio more than you did at the bottom of a bear market, it really hurts. And if you really want not to be hurt by that, you have to get in some filters and additional layers of process before you make your decisions. Only then you can pick bets which are worthy of being the best bet in your current portfolio. At a time like this, when everybody's portfolio is near its all-time high, am I right? Most portfolios are closer to the all-time high. I mean, when I wrote this slide, it was a week ago. A week is a long time in the stock market. But assume that 1 week ago, it was an all-time high, right? So, at that time, if you were thinking of your portfolio, which has already gone 5x probably from the bottom of COVID, what if this were 5x more? If your portfolio is 5x more, are you ready to handle such a portfolio? Which is 5 times the size of your current portfolio, 10 times the size of your current portfolio. When you ask yourself this question, then you will suddenly see all the inadequacies in you. You will see where you have not evolved adequately, where you need to evolve, where you have gaps in your skilling, in your personality, in your temperament, in your preparation, in your process. All the gaps will start looking very, very clearly to you. But asking this question is always very important. You know why? You are going to handle a portfolio 5x or 10x of your current portfolio in the future. If you think about this, you'll do it sooner than you otherwise would. Because all the preparation that you do, all the thinking that you do in the present for the distant future actually helps in the present. And that's why this question is extremely relevant. This is a very interesting question. If I had asked it in 2020, people would have thought that I'm jealous of others. But is consistent return generation really possible? Is it possible? How many of you in this room think consistent compounding or return generation is possible? Nobody. But everybody bought a book and read it. You cannot always keep winning. That's the honest, hard truth. And if you believe in consistent compounding, you are thinking that you are bigger than the market. Somewhere that narcissism comes into your investing. And when narcissism comes, you're cursed. Because you fail to see your own weak spots. If you think consistent return generation is possible, are cycles a myth? Assets go through cycles. Equity as an asset will also go through its cycles. Simply because some countries are printing money, you cannot expect that you'll have bull markets all your life. It's not possible. So, ask yourself, are cycles a myth? Cycles are not at all a myth. And do you have an antidote for everything? I find that when people believe in their ability to generate returns and when that belief is in excess of their abilities, the tendency is to give you an impression that they know how to deal with every situation. But the truth is, none of us know how to deal with any situation. We don't run companies. We are not creating their P&Ls. We are not selling their products. We are not running their balance sheet. And yet we think as investors that we can control situations when they go out of control. And that we could always homogenize and create returns which are consistent. Returns will always be inconsistent. All we can do is try and make them less inconsistent through our persistent effort and through preparation. This is another question that I ask myself. If you make a fresh bet today, are you okay with a 5-year lock-in? And this is not a question I've asked myself today. It was in 2018 when I went into private investments. And it is 6 years since I went into private investments. My investments are still locked in, and I'm quite comfortable with that. And the gestation only increases. When you are able to make a decision today, and you're confident of locking it in, I'm sure that you would have made a lot of preparation, groundwork, research to back your decision. Otherwise, if you're given the option of selling anytime, I think that your decision making will be more simplified and probably oversimplified. But if I tell you that your decision has to be locked in for 5 years, then you need to think very, very hard. Many people think of success as an indicator of maturity. If you are a very successful investor who became very rich, does it mean that you are a mature investor? My observation is, in most cases, success breeds rampant immaturity. Investors become more immature when they are hugely successful. It's very human. So when do you really become a mature investor? When does a person become a mature investor? You become a mature investor when you can pick a 10-year filter to buy stocks. Can you apply a 10-year filter to pick a winning stock? Can you buy a stock today which you won't sell for the next 10 years? Then you can't be letting your ego run all over the place. You can't be emotional. You can't be sentimental. You'll think very, very hard whether the idea will work. How many people are there who buy and hold for 10 years? Very, very few. It's a very small number. Now to the question that I was struggling when I entered the stock market, and I see a lot of people struggle all the time. They want to leave their jobs and become full-time investors. Is full-time investing really a good thing? How many of you in this room think that full-time investing is really a good thing? No. Hardly a few. To my mind, full-time investing is probably the worst thing that can happen to a person. Because they restrict their life to just one aspect and they don't have any other dimension. Anyone who is a full-time investor actually has no life outside of investing. And that life in investing is also miserable, however successful they are. All the money that they make doesn't give them contentment, happiness, it doesn't give them anything. If you're doing other things, then you're spending a lot of time on those things, you're spending a lot of effort on those things. It may be a small business, it could be a small service, it could be teaching, it could be anything. If that is the primary vocation, then you're much better off than being a full-time investor. That is why you don't see full-time investors being happy investors, being contented investors. This is another question. I know a lot of people are going to have different opinions on this. Are professional investors smarter than proprietary investors? What is the view in this room? No. Why? Why? Let me listen, then answer first. Sorry? It's your money. Okay? Very valid point. Thank you. Professional investor is forced to invest. He doesn't invest by choice. He is compelled to invest.
Facing peer pressure.
Peer pressure. is there in professional investors. But do you think that proprietary investors don't have peer pressure? Don't they compare all the time? The truth is, proprietary investors come out smarter than professional investors. I've seen both sides of it, and I can tell you why. A proprietary investor can be creative, he can be adventurous, he can be exploratory, and he has no timelines. That's not the case with a professional investor. He has deadlines. He's judged all the time. He cannot be exploratory. He doesn't have the bandwidth to fail. And when you don't have the bandwidth to fail, your risk taking is tremendously restricted. So, what this means is the professional investor actually has to be far more conditioned and disciplined than a proprietary investor. Why do professional investors still have a role in this world? Because most investors who do proprietary investing are very, very indisciplined, or they don't have the time, or they don't put in the effort that is needed to invest. As a result of which, conditioned investing, which the professional investor can offer, is better than what the investor can do on his own. That is why professional investors are here. But proprietary investors always have an advantage over the professional investors because of the freedom to do what they like in a manner which gives them comfort with no deadlines or timelines to deliver investment performance. Should I worry about beating others in investing? This is something that I have been thinking more after I have a professional role. As long as I was a proprietary investor, I was never worried about beating a benchmark. It never mattered to me. And when you never think about beating a benchmark, you will beat the benchmark. It's only when you have to think about it every day that the problems begin. If you love cricket, and if you're a batsman who has to look at the scoreboard every day to see the run, every ball to see the run rate, it's very difficult. So, beating others cannot be an end, and definitely should not be the starting point. In my opinion, investors who worry about beating others in investing, and when I say others, it could be a benchmark, mostly struggle because their head is full of what if I fail? What will others talk about me? What are people telling because I am 0.2% behind a benchmark? It becomes so soulless and boring with no scope for creativity, no scope for experimentation, no scope to stand outside the crease and hit a ball. Absolutely zero scope. So no investor, whether professional or proprietary, should worry about beating others. If you really want to be successful in investing, don't worry about how you are doing in relation to others. Race against your own needs, your own benchmarks, what you think is a reasonable performance in a given market context. In this market context, if you lose less, you are a good investor. So, once you stop worrying, you develop a sporting spirit of life. Sometimes somebody else will do well, their stocks will fire. You may be buying old boring stocks, old economy, they are not firing. If you are in capital goods from 2015 till 2021, 6 years may be bad, but in 2 years you make good. For 6 years, your friends who bought everything else under the sun may be doing great. If you're an infra fund manager, your life is horrible, but you still have to manage, right? So you should have that sportive spirit of life, not say, "Arey, why are these people running behind this small cap guy? Why are they going behind this some other fund, who is doing well?" So if you don't worry about beating others, you will have a sportive spirit in life. You will agree that you win some and lose some. And you will accept that to win big, you wait long. There's no alternative. So if you keep on worrying, At some point, you lose that joy of fighting, the joy of doing what you do, and you will not be anywhere near the joy of winning. Worrying kills everything. All joys, it's the absolute kill joy. Why should you not take the investment profession seriously? I think you should not take investment profession seriously. I see a lot of people looking at the professionals all the time, 24/7. At times, I find that people who follow me on Twitter know better about my fund's performance than I know. Like, I would not know what is the last digit return or what happened. But people have no life. They take this profession so seriously. And they have no skin in that game, actually. It's not something that helps them at all. I don't know what satisfaction people get out of it. Maybe they're not doing that well or they're doing too well. One of the two things. Otherwise, why do you worry about what others are doing? Like, I have a close set of peers with whom I am working for the last 3 decades. And we don't know each other's returns. We never asked that question. In fact, we have never even asked the question, what is the size of your portfolio? But we talk about stocks all the time. We talk about businesses, economy, everything. But there is no conversation about what is the return. But people who have no skin in the game take the profession so seriously. The profession has a lot of drawbacks. It cannot lose money for the investor first. If it loses money for an investor, it loses the investor. Which means the risk-taking capacity of the profession is very, very low. All the products I manage are lower risk than the index which is benchmarked against. I created the product only in that way. I cannot be this adventurous investor who stands outside the crease when the ball is bowled. I have to stay well inside the crease. So there is no need for you to take this profession seriously. It is just like any other profession. I see no difference between inventory manager in a factory and fund manager. Same. And most of the things in this profession are out of control. People give you money when you don't want them to give you. People refuse to give you money when you tell them, please give me money. Behavior is controlled by the investor. How much can a professional do to compensate that? So this is not a profession that should be taken so seriously. The investment manager is like the diabetologist. You write all the prescriptions, everything. Tell what all should be done. But the patient doesn't follow it absolutely. Very few people follow. Most people don't. I remember somebody giving an example of a very powerful leader. The diabetologist tells the leader, don't eat these sweets. The leader tells the diabetologist, you write the prescription, give me the injection and get out. We are like that diabetologist. Professionals are like that. So don't take us so seriously. Only the patients who listen are going to be healthy and happy. The rest, it is our duty to somehow make them listen. So it's not a very exciting profession. It's a very boring profession. And there is one more reason why you should not take the profession seriously, because you think that, oh, this guy's funds are all doing great. Oh, this guy is doing fantastic. Only when you think you are at the peak of your success, failure is waiting outside your door. Just outside. Because everybody will give you money. Come on, invest. And you can't invest. And you have seen that in the recent cases where, people gave money to mutual funds in the small cap space, stuffed them to the ears, and they went and invested in companies which are not small cap, thinking they are defensive. And those stocks are all down 20%. Look at the irony. So when you are at the peak of your success, failure is outside your door. So don't take us professionals seriously. This is something that I think is important. Maybe it's due to my investment age, which is outside the chart that I put out. So why is longevity more important than performance? Anyone? Very simple. If you die in your 60s, the kind of wealth you can create at the same rate of return is far lower than what you do if you die at 90. So just being alive and playing the game itself is a blessing in equity investing. So you don't have to worry too much about anything else. So I go back to Hari's point on the sweets and Raja's persistent effort to make me eat sweets, which I can easily succumb to. So longevity is more important. So just playing the game and staying in the game is very, very important. Yet, we don't think highly of it. When I see an 80-year-old person who's still in the market, I'm very curious. I ask him, what are you doing? Are you doing trading? My uncle, who was the first person I saw come into the market, is still very much active. He is 85. He has a table, a chair, a big screen, Odin, and he's got all the stocks, pages after pages fed there. He's always buying or selling something. And then I ask him jokingly whenever I meet him, what did you do today? He will say, I bought this, I sold this, something or other. He doesn't make any money out of all that. That's not the issue. But his investment book is doing very well. He's alive, kicking, seeing the portfolio compound. That's the good news. So longevity is more important than performance. You can be the best of investors, but if you die early, there cannot be a bigger tragedy. This is another thing that people don't understand. When you see very successful investors, you think that they're doing everything by themselves. They're genius, wizards. Not true. Successful investors need advice more than novice investors, actually. A guy with a few thousand crore portfolio is more vulnerable. He needs more advice than the guy with 1 lakh, the zerodha guy. But look at the irony. The 1 lakh guy thinks, oh, I can do everything on my own. I am Abhimanyu. Who can become Arjuna. It doesn't happen that way. Most people, when you look at very large investors and you see their names in shareholding and here and there, you think it's all one-man show. It's not. There's so many people behind who are doing a lot of work. You can see a 10,000 crore bet in Titan, but you will not see who did the groundwork behind it. Who are the people who are the sounding boards? Who gave the insight on jewelry? Who gave the maintenance research? From outside the company, not inside. Because a lot of things that happen outside companies. You're not supposed to go and speak to companies beyond what is mandatory. But you can talk to their vendors, you can talk to their customers, you can talk to people who run the same industry in another country. You can look at another company in another geography. Like we are doing this exercise constantly. There are at least 3 or 4 companies that I have invested in where the research is completely in the American parallel. No research in India, 0 research in the Indian company. All the research happens in the American company, which is a far more mature company in the same industry. And the only question you ask yourself is, does this company fit that template? Does this company fit that model? Is it the same or is it different? How different is it from this company? And if you see a lot of boxes ticked, then that parallel company becomes the guide and a proxy advisor to make an investment in the Indian company. And I will shamelessly say I have numerous advisors, numerous young people who work with me, who discuss ideas with me. When they tell the idea, I listen patiently. When the idea is early, I tell them your idea is early. The idea fails in the near term. We keep on talking. At some point in time, I start owning the idea. As much as they do, sometimes more than they do. Clearly, the youngster is my advisor. I acknowledge it. I have no hesitation acknowledging that younger people are very good advisors. Even to experienced investors with a lot of experience, a lot of track record. Still, younger people will always be very good advisors. And successful investors need advice more than novice investors. Not a lot of people even think about it this way. Why do you not think about it this way? Because you're seeing AAM. You're seeing portfolio size, so you think that person knows to do everything on his own. Not true. He doesn't have time first. Now this question, which I think becoming very popular. See, what is indexing? It's just throwing money into a set of companies. Are you controlling how much capital is thrown into this universe? So what is happening in small cap can also happen in the large cap, right? You mindlessly throw more money than the space can absorb. Why do you have excess valuation in all these FMCG companies? Culprit is EPFO. If you are seeing 100 PE in Titan, don't think it is the genius of anyone. It is the stupidity of EPFO. It is because of indexing. Tomorrow, if they change the method of investing in EPFO, which they will, because government is responsible for a bubble, they will have to remove it or at least curb it or curtail it. So indexing is not a one-stop shop. It is not fail-safe. It is not something that you can say is always going to work. It's just dumb, stupid investing. Most of the time. Except in April 2020 type of situations. Then it is smart. Because you don't know what to buy. You just put your money. And also, in an economy which is growing 6-7%, if you say that I'm going to do indexing, you're going to participate in a very narrow part of that economy. You're not going to participate in the high growth areas. You're not going to participate in any opportunity where there is asymmetric growth potential. Now, this is another thing. Many people say I'm into investment for learning. And they'll always be competing with the next person. They'll always be comparing with somebody else, how they speak, how they express, how they ideate. Always trying to look at the other person. How many of you have seen the film Amadeus? This is a life story of Mozart. Yeah, Amadeus is a story which had a very deep impression on my life because I saw it when I was in my teens, much before I thought of becoming an investor. And it's the story of Mozart told by somebody who was very, very jealous of Mozart. You can watch it even today. It's an Oscar-winning film. It's available on OTT. You must see this film. Investment learning is not a competitive pursuit. It's like music. That's why I'm saying I'm bringing the parallel up because you're doing it for yourself. If you're going to sing because somebody has to clap for you, I don't think your singing is going to get the claps. You're still listening to a person who died every morning, not to clap. And when that person sang that song, which is the morning awakening song for all of you, like the Suprabhata, she didn't sing it to get claps. Right? Investment journey is a way of life. It's deeply personal. If you see why Charlie Munger is respected more than Warren Buffett, which is the truth, you'll have the answer. It's very clear because I think that he practiced it in a way in which it was a way of life where he was trying to become a better version of himself all the time. And this is the other thing. Too much of calculation in everything. You do calculation about how your SIP is going to become something after so many years. I mean, where is the guarantee? And all the apps will give you calculator. And there's calculator for everything. Calculator for your cancer treatment. If you're becoming a cancer patient, how much money you require? Calculator. It is so stupid that we have become slaves of the calculator. Slaves of, when I say calculator, Excel is the worst calculator. Right? You are always using Excel for everything. And they are weapons of mass destruction because they take away your creativity, they take away your ability to ideate, to think of the future. Because you're only doing this, number crunching, all the time. And the best returns don't come from number crunching. I can tell you from experience, my best investment decisions have not had anything to do with an Excel or a calculator. Zero. They make you oversimplify. Everything you want to reduce into one number on one field. What do you call that? Cell. Sorry. Yeah. That shows how far away I am from Excel. And they turn you overconfident. Most of the people think that they have done personal finance. They have become mastered personal finance because they went into an app and did all these calculations and did elaborate Excel. I see a lot of people, my clients will come with very elaborate Excel. And then I'll ask them some basic questions. Then say, okay, I'll rework and come. So what happened? When they come, they say, oh, I've done all my math. Everything is in this Excel. But the Excel only makes you overconfident because you oversimplify it and you have failed to see some basic things. And because you do that, you are underprepared. You miss out on something very basic, most of the time. Avoid Excelvad, like India has a lot of Naxalvad. Excelvad is next to that. Try to, keep Excel where it should be. Don't be number crunching because investing is not about number crunching. If you did number crunching, you could never buy a stock like Nvidia. It will always look expensive. All the best stocks that have returned 30-40% returns. Shyam will agree with me. Why professional managers like us fail to buy it is because of calculation. Expensive, fairly valued, not cheap. We keep on doing this. Whereas the company is performing outside the calculator. Its performance is outside the Excel. So you miss all the outlier because of the mediocrity of Excel. But there is something that is good for all of us. So Diwali Eve, let's say what is good, right? Becoming rich is no more a distant dream. If everyone in this room says that I want to have $5 million, it's possible. It's definitely possible. Everyone can do it. And that's the good news. But there's a spoiler. Staying rich is not as easy as you imagine. I've known people who had $10 million in 2000. They don't have $10 million today. What happened? What do you think would have happened? They are not prepared to be rich. They have not thought about what it takes to sustain, what it takes to make sure that your wealth doesn't get eroded, what it takes to moderate your expectations once you become rich. Suppose you have doubled your money 2-3 years for 10 or 15 years. You can't be doing that all your life. So you need to moderate your expectations. So staying rich is not as easy as we imagine. And one thing, oh, I can take risk. This is what people tell me. Oh, I don't mind my portfolio going down. But as you grow older with every market cycle, you can't play your life like you're playing snake and ladder. You can't go up and then come down to the bottom and then go up and then come down. The toll it will take on your health, on your mind, on your psyche will be very, very heavy. So you can't play life like it's a snake and ladder game. Which means that you must somewhere try to moderate and protect yourself. And this thing about risk taking, oh, I'll have only SME portfolio, full portfolio SME. I'm playing India game, I'm going to grow India. Government can't do it, State Bank of India can't do it. What are you? It's a joke actually. So risk taking is not a 24/7 game, it is not. Yet we think it is a way of life. And you know the tragedy is if I think that risk taking is a way of life and convince all of you, I'm ruining you. Risk taking is not a way of life. So it all comes down to the problem area, which is the mind. Your mind is a battlefield. Make sure you are the one in control, not the demons. And the stock market is a place which fills the mind with demons. The demons take complete control, like that film Yandiran. Yes, there will be failures. At a time like this, when we had too much of sweets from the market and more sweets waiting for Diwali, there will be a risk of falling. Everyone will fall. And I'll share this example. In 2000, we had no tech stocks in our portfolio. In 2008, we had no infra, no capital goods stocks in our portfolio. In 2000, we told ourselves, we don't have all these stocks, so we are safe. Market fell. We also fell with the market. And you know what? We fell more. Despite holding value stocks, dividend yielding stocks, safe companies of TVS and Murugappa, we fell more than the market. So the risk of falling is real, but you should be well placed that you will rise every time you fall. And you must try to fall less. That is something that should be an objective at a point like this. And how do you do this? You can only do it by yourself. Nobody else can do it for you. You alone are enough to silence the demons in your head. So you have to listen to where you are going wrong, where you could potentially see a lot of pain, where you are not thinking objectively. All the demons in your head you have to clear one by one. And only when you rise above that noise, you will hear your own voice, and that's all that matters. Friends, it is not easy. In every market cycle, if you are able to do this before returns, chances are that you will make better returns in the next market cycle than others. You have a fair opportunity. You're giving yourself that fair chance to yourself. And that's why I make this point here. If you're going to fill your portfolio with junk because they are running at a faster pace, you will lose capital at such a rate that you will never be able to recoup. That risk is real in every market. That risk is there in every market. So if you think that something is going up very fast and you run behind it, when it goes down, it will go down faster. The reason why people like us are here at this point, at this level of investment performance, is because we are always careful when this kind of an environment presented itself in the past. And we know that every time we have to be more careful than in the last cycle. So today we need to be more careful than 2018, far more careful than 2008. And look for places like we had in 2000 where with no business you gave very high valuation, with no business. In 2008 we gave valuation with no cash flow based on revenue. Sales multiple is not an investment metric which can be reliable in small businesses. It can be disastrous. But people are overconfident in giving sales multiple. End of the day, if you are able to clear your head of demons like these, sales multiple, what valuation is reasonable, which sectors are overvalued, if you clear all these demons in your head, you are going to be safe zone. And there is a need at this point in time as we head into Diwali week to safe zone ourselves. I thought about this concept a week earlier, but the concept has become more relevant in 1 week. Probably more, it will turn even more relevant in the next week. And unless you are able to slay your own demons, it's not going to be easy being an equity investor in the coming years. Thank you very much for your patience here.